But there's a reason that MCI and AOL and all those companies were out near Dulles Airport. So you're sitting near May West, which is the intersection point for the internet on the West Coast, right? May East sits right under Dulles Airport. So if you fly out of Dulles now, if you look down, you will just see server farms forever because it's such a fast interconnection point. So Dulles literally sat on top of May East because, I mean, it's mind-blowing, but something like 70% of the internet traffic in the world was going over AOL servers in the late 90s.
Well, I remember hearing when I was there in the late 90s, it was people said 50% of all internet traffic, that includes some guy in Paris looking for a restaurant in Paris, was going through
Right.
May East.
That's
But
right.
I think, but the other reason I would have thought was that, like, if you're MCI WorldCom, they did 12 public offerings. That's why the first one's called the initial, just
Mhm.
to fight with the US government for their right to exist with deregulation, right? So I always thought, like, you know, Bill Gates was way off there in Redmond outside of Seattle, where these guys were like,
Yep.
hey, I'm going to park myself right outside the door and lobby the US government to make sure I'm allowed to exist and I don't get shut down with all those
Well,
conflicts
so
of interest. So I kind of thought that was the reason why there was so much telecom talent. That's why I put my startup in Tyson's Corner.
it's definitely fundamental to the thesis of us being in Washington. So Steve and I left AOL Time Warner. We started Revolution 20 years ago. Started really as a family office, and now as a purely institutionalized set of funds. I run a thing called Revolution Ventures, and two of the things that I think differentiate us in the market. One is we sort of pioneered this concept of investing all over the country. So we are based in DC. You make that point. The DC
Which was
ecosystem.
not obvious. That was not the go-to move in, what was it, 2004 when you guys started?
2004. That's exactly right. It's a total outlier strategy. People, we would talk to our friends on Sand Hill Road, and they'd say, "That's the kind of, that's nice. That's really cute. It seems really hard." But for us, it's where we generated our returns. We knew that DC was not going to be big enough to support our aspirations. The ecosystem here is wonderful. We love Washington, but it's not big enough to support a multi-billion-dollar sort of
Yeah.
multi-strategy approach.
Hello, and welcome to Fireside with a VC. My name is Andrew Romans, and today we're with Tige Savage, who co-founded Revolution Ventures 20 years ago with Steve Case, infamous for setting up AOL. So we're going to get into his background that led him up into venture capital and how I think this is a different kind of VC fund, and we've been excited to have them show up in some of the companies we've invested. So Tige, great to meet you.
Yeah, back at you. It's good to be here, and congratulations! You guys just surpassed 100 episodes on the podcast. That's a huge threshold for anybody doing this. So it's nice to be on.
Oh, thank you. I try to not go over 2 a month. So Tige, tell me about your background before getting into venture and Revolution. What was the background leading up to that?
Yeah, so before Revolution was venture. So leading up to that, really the early part of my career, I was lucky to work with a guy who became a mentor to me. He was a founder of or he had built a big private media company, and he was in the banking business. And that's, I really learned business from that guy. His name is Joe Albritton. He was kind of a legend here in Washington, D.C. And he is the one, I ended up on the board of his media company and then ended up doing some private investments for that media company. And he's the one who really staked me to get into the venture business. So essentially kind of a strategic media focused venture effort. From there, when AOL and Time Warner merged, I went over there
And
to
what year
over.
was that? That was like the case study of all MBA cases of the most synergistic of all mergers. Almost could have been an antitrust, and then in the end, it was
Yeah, it
like
was
Ted
bananas. I mean, it was
Turner.
strategically a good idea. Everybody knows that the outcome of it wasn't great. Time Warner, I think, is a hard company to own. If you look at all of the folks who try to acquire Time Warner, I think it's been a rocky road. But it's impossible to argue that the idea of online distribution and media didn't make sense. But I don't think it made sense necessarily at that time, and I don't think it made sense with those two companies. The perch for me was really interesting because I was not an AOL guy. I was not a Time Warner guy. I came when those were put together. I was at the AOL campus because that's where the tech people were, and we could do most of our diligence. But most of the work that I did there was for the media companies. So like Time Warner Cable, this is a million years ago, but you forget, like, cable was an institution back then, and they were worried about satellite like encroaching on their business. So we would invest in platforms that would essentially take advantage of the bidirectional nature of cable, because they could then compete against satellite. So voice over IP, which didn't exist then, video on demand, which wasn't really a thing. So we invested across the various divisions, and then for the media companies, did that for a while. But that was really at the dawn of the cold winter of the sort of .com crash. So it was a lot of also fixing up portfolio companies that already existed. But a very interesting perch. And then
And it
from
sounds like,
there,
you were
yeah,
doing, in some ways, you were doing nascent corporate venture capital, CVC. So if you're making
100%.
investments, you're making investments on behalf of a media company. Are you looking to make a financial return? Yes, but you're probably looking for strategic, synergistic type of investments.
Yeah, so there were really two efforts in this regard. So there was the early stage venture effort. That was the thing that I was involved in. That was called um, Time Warner Ventures. And then we also had corp dev groups. And the distinction between the two, at least at that entity, was if a company was ready to strike a deal with Time Warner or Time Warner Company or AOL, then they would deal with the corp dev folks. But if it was nascent and it was an interesting idea, or it was an area that could be disruption for an existing business, or something that's ancillary, early, not ready to do a deal, then that was sort of our domain. So they would be companies that were not ready for a strategic partnership, but we're ready for something around the ancillary. So that's how we split it up.
And over the years, because you've probably got more experience in CVC, corporate venture capital, than many others, and then evolved into maybe pure venture capital.
Mm-hmm.
But how do you think, what's the right policy for separating corp dev and investing? So corp dev
Yeah. So listen,
M&A versus, being a minority investor trying to support a company.
well, listen. I know you've thought about this a lot, and you've written about it. I definitely have some views on it. I actually think that the model that we had there was pretty good. There's so many conflicts. There's not a perfect answer. Corporations, as a rule, tend to get into venture capital at the wrong time, get out of venture capital at the wrong time, because it's
Right.
such a right. So you have to take that into account. But listen, as a general rule, people are not investing in companies to get exposure to the venture capital asset class. It's not what they're doing. They're investing in companies to get exposure to what that company is doing. Now, I think smart companies worry about being disrupted. They worry about competition, those kinds of things. And a tool in the toolbox for the right kind of company is venture capital. And I think if it's a innovative, tech forward style company, then venture capital can play an important role. I think corp dev almost always plays an important role for companies, either in terms of partnership, M&A, putting equity behind a partnership, et cetera. But the way that we did it, as I said, early stage was a pure minority investment. And then later stage was through the corp dev group. There's always the question of how do you get paid? Like, what are the economics? It's hard to keep venture people, right? Given the economics and the way that it works, it's hard. In deal making, as a general rule, I think alignment, like, that's the key thing that I focus on when we're trying to invest in companies or doing M&A or whatever. And that's a really hard thing to do with corporate venture capital, because people want to be rewarded for the things that they're working on. It's kind of hard to do that when it's so specific. The investment or the return structure of a VC effort is so focused on, like, those portfolio companies. It's hard to do with options in the parent company. But if you create incentives in that little portfolio, all of a sudden you're working to drive returns out of the portfolio, which is inconsistent with why a company should be doing VC in the first place, which is to amplify the value of the core business. So there's no perfect answer.
Yeah.
It is full of conflicts. But I think that companies that do it right have to do it for the long term. And then they have the trick of trying to keep the employees focused on doing it, because a lot of them end up going to financial VCs.
No, I think everything you said is huge, huge wisdom. I like the word alignment so much. I even tried to get alignment.vc, but it was taken. I think that's just, that's just a key. I think if you
Yeah.
pretend to pay people, they pretend to work. That's like a failed Soviet model. And a lot of CVCs that failed to figure out how to align, incentivize the people doing that important work. The bad ones stay and the good ones leave.
Right.
Seeking compensation. And if you recognize, each CVC will be a little bit more strategic, a little, driving corp dev, or a little more financial, and strike their own unique balance. I think if you want to architect that from the top, you need to incentivize people for strategic returns, for if it becomes a multi-billion-dollar recurring revenue
Right.
stream, or it helped us diversify out of mobile networks into data centers, or whatever they were strategically trying to achieve.
Right.
You just gotta, if you pay people, they will do it. I mean, I remember reading Chuck Newell's book, co-founder of NEA, who I had on the
Yep.
podcast, and in reading his book, it said they were paying the partners for every board seat they took. So no wonder NEA was on 47 boards. Each. At first I was like, "What's wrong with this guy?" I mean, his wife must hate it. It's not good for the founder. It's not necessarily
Right.
good for the LP, but it's like, hey, you offer that guy an extra couple bucks for every board he's on. Lo and behold, he's on 37 boards, joining another 10 in the
Well,
next 3
listen, I'm sure
weeks.
this is the feedback you give to your CEOs, and the best CEOs know this about their sales teams. Like, your sales team will figure out how to exploit a flaw in the system if it pays them, because
Yeah.
they're, people are coin operated. So I think you're on I couldn't agree with you more.
To show how dated I am, and maybe this will make you laugh. I remember the best example of that was IBM incentivized the sales team that they got a bigger commission for selling a mainframe than they did from the AIX RISC chip Unix box. And so they were like, "Hey, we've just gotten back from this big rah-rah offsite to sell you a network of Unix workstations, which if you network them together, better, more powerful than the old mainframe. But let's be honest, the mainframe is safe. The mainframe,
Right.
because they
Right.
got his commission on this service agreement was sending his kids to college, whereas this AIX thing died because of the sales team bad incentives. You should have had a separate team or something. Let them fight it out. But so
Yeah.
I want to get into Revolution, but I spent a lot of time in DC. I had a startup in Tyson's Corner. I got my MBA at Georgetown. So I love Washington, DC, and that ecosystem. For me, it's kind of a long time, and I'm kind of out of the system. But you've been in DC throughout, right? You were in the DC from the 90s
Yeah.
until today. That's
Yeah.
that's awesome. And AOL was what, Arlington or
So it was out near. Actually, this is an interesting story. I'm not going to waste too much time on it. But there's a reason that MCI and AOL and all those companies were out near Dulles Airport. So you're sitting near May West, which is the intersection point for the internet on the West Coast, right? May East sits right under Dulles Airport. So if you fly out of Dulles now, if you look down, you will just see server farms forever, because it's such a fast interconnection point. So Dulles literally sat on top of May East, because it's mind blowing, but something like 70% of the internet traffic in the world was going over AOL servers in the late 90s.
Well, I remember hearing when I was there in the late 90s, it was people said 50% of all internet traffic, that includes some guy in Paris looking for a restaurant in Paris, was going through
Right.
May East.
That's
But
right.
I think, the other reason I would have thought was that, like, if you're MCI WorldCom, they did 12 public offerings. That's why the first one's called the initial, just
Mhm.
to fight with the US government for the right to exist with deregulation, right? So I always thought, like, Bill Gates was way off there in Redmond, outside of Seattle, where these guys were like,
Yep.
"Hey, I'm going to park myself right outside the door and lobby the US government to make sure I'm allowed to exist and I don't get shut down with all those
Well,
conflicts
so,
of interest." So I kind of thought that was the reason why there was so much telecom talent. That's why I put my startup in Tyson's Corner.
Huh. So I'm not sure if that's true with MCI or not. It's definitely fundamental to the thesis of us being in Washington. So Steve and I left AOL Time Warner. We started Revolution 20 years ago. Started really as a family office, and now as a purely institutionalized set of funds. I run a thing called Revolution Ventures. And two of the things that I think differentiate us in the market. One is we sort of pioneered this concept of investing all over the country. So we are based in DC. You make that point.
Which was
The
not
DC ecosystem.
obvious. That was not the go-to move in, what was it, 2004 when you guys started?
2004. That's exactly right. It's a total outlier strategy. People, we would talk to our friends on Sand Hill Road, and they'd say, "That's the kind of, that's nice. That's really cute. It seems really hard." But for us, it's where we generated our returns. We knew that DC was not going to be big enough to support our aspirations. The ecosystem here is wonderful. We love Washington, but it's not big enough to support a multi-billion-dollar sort of multi-strategy approach.
And telecom kind of died up. Telecom kind of blew up. Like the days of selling your Chromatis networks to Lucent for $7.5 billion were kind of over. So it felt like a lot of the Columbia Capitals and the guys that were around when I was there seemed to have moved on to to other more infrastructure kind of stuff, and the internet kind of took over. But there's still only one unique Washington D.C. But clearly, you guys said it's kind of like Israel's too small. Let's take the whole world over.
Right. So one is we did that, and the other is the point that you made, which is policy is in the DNA of our firm. We're in Washington. We've been here forever. And we've argued for a long time that understanding what's going on in Washington is important to your company, not just when you're filing your HSR and hoping that the FTC is going to isn't going to file an antitrust for your merger. It really matters to the life cycle of these things. So both the idea of investing across the country and the idea of caring about what Washington says were outlier concepts 20 years ago. They're not any longer. Right. I think everybody realizes that Washington plays an important role from a regulatory standpoint, from a policy standpoint, in opportunities. The low-hanging fruit is gone. It's these regulated industries that are oftentimes the ones that where there's real opportunity, but they're hard to penetrate. But I think that's a more mainstream view now, and certainly over the last 20 years, and absolutely catalyzed by COVID, I think we have a leading brand investing across the country, but it's not a unique strategy to us any longer.
Well, it's certainly a unique brand, and for some of our listeners may not even know who Steve Case is. So maybe why don't we rewind for a second, take a sidebar, and explain who is this man, and what did he start, and what was the outcome of that?
Yeah, so Steve joined a company called Quantum Computer early in his career. That became AOL. AOL was, it's crazy, but it was the Google of its time. In fact, AOL played a critical role, probably a big strategic fumble on their part, in making Google successful, because Google trained it. Basically, Google got the deal to do search on AOL. The volume was there. It trained their algorithms. When Amazon fumbled in the early 2000s, AOL put $100 million into Amazon to
Is that
help
right?
keep them afloat. Yeah.
So that's a Yahoo Alibaba investment practically, my God. Right?
Yeah, same kind of thing. Although I don't think that AOL was smart enough to hold on to that investment into perpetuity the way that they have with Alibaba investment. Yeah.
Well,
anyway, so AOL became sort of and we talked about it. The majority of the internet traffic in the world was going over these servers. This is 1 million years ago. And there was a vision to merge media and distribution. Good idea, bad execution. That was the merger of AOL Time Warner, which at the time, was this $100 billion merger or whatever the number was. It was, those numbers aren't big today the way they were then, but it was
they were big then. These were the biggest of numbers.
It was big then.
Can I think we have to say though, like AOL stands for America Online. So, in the early 90s, you had HTML, and Novell had a monopoly on networking computers, but there was
Poke and Ring.
That's right. There was no fixed internet. There was no fixed wireless. Or fixed internet. There was no wireless internet.
Yeah,
And so you buy
yeah,
a
yeah.
PC and say, "How the hell do I get this thing on the internet? I want to go check out a website." And people said, "Well, America Online." And I still am amazed that AT&T, with other government swing, allowed Steve Case to build these modem banks and just connect to. So he connected to their infrastructure with these modem banks, and then sent you a modem with those CDs that were coasters in every coffee shop in the
Right.
world. They were like mailing them in every mailbox in the country. And people were like, well, this is free. I can connect to the internet over this like 96 baud modem. And so you guys had, I don't know what percentage of US connections to the internet, but it felt like more than half. And so this was just the biggest company that was getting America Online, hence the name AOL.
Yeah, no, yeah, no, that's exactly right. And obviously, time progressed. I think, and I wasn't at AOL in those early days. That was before
Okay.
my time. But the marketing strategy that you talk about, most of your listeners don't, it will blow their mind. But that's exactly right. I mean, the equivalent of what you see for online ads today was plastering people with CDs, because it's how you download. You couldn't download software back then. You installed software and you got online. You did it. And then the companies were merged. As I said, I joined to oversee the venture capital group. We were there for a couple of years. That's how I got to know Steve. And then Steve and I left and we started Revolution Ventures to essentially continue with some of the early stage vigor that is always lost when companies get big, and invest against new strategies.
And there's also like the rise of the revolution. Could you break down? There's sort of multiple. I believe that there's
Yeah,
multiple different entities, and some are even have a philanthropic side to
yeah,
them, or perhaps they all
yeah,
do. Every VC can claim to be a philanthropist, but I don't know how true that is.
so we do have three efforts. I'd mentioned that we have a history of investing across the country. That's a strategy we call the rise of the rest. The rest is rising. And we basically started as family office for Steve. We invested about $500 million of his personal capital while we did our first deals. And then ultimately we institutionalized the firm. And we institutionalized around the sort of the core skill sets of an early stage group. That's what I oversee. It's called Revolution Ventures. We have a later stage group that's called Revolution Growth. And Steve is now a small minority investor in Revolution Ventures. We're an institutionalized fund. Steve's on our investment
Outside
committee.
LPs, so you have outside LPs, 2 and 20
All
structured
yeah,
GP.
we are a regular looking institutional fund. The days of this being a Steve Case entity are 15 years ago, right? So
Okay.
he's a small percentage of the invested capital, and we're a DC based entity. There is a seed fund that we call the Rise of the Rest Fund. And while they don't call themselves an impact fund, that's a good way to think about it. Their LP base and strategies are different than ours. So ours are traditional institutional investors in the way that you would think about it. The LPs in the Rise of the Rest Fund are some of the best known, wealthiest entrepreneurs and tech entrepreneurs that are out there. And they've invested against a concept of using capital to reinvigorate the center of the country. So we invest all over the country. We invest in California, we invest in New York, we invest in Boston, Washington, D.C., and everything in between. The Rise of the Rest Fund, this more impact-oriented approach, only invests really off the coast, inside the country. We lead our deals. We take large positions in these companies. They're completely passive investors. They invest at the seed stage, essentially to build ecosystems. We're obviously the beneficiaries. Everybody's the beneficiary of those ecosystems as they emerge. So really three things to think about. A Rise of the Rest Fund, which is sort of a different capital base and a different investment profile. And then basically seed Series A fund. That's what I am involved in. And then we have a growth fund that is a later stage, sort of a growth stage venture fund.
And can you break down for Rise of the Rest, not the coast, center of the country? And I've seen you
Yeah.
guys in like one of our deals out of Dallas, I think. What's check size? What's the range of check size? And pre-revenue is not too early?
For the Rise of the Rest Fund, no, they invest at the earliest stages, and They do $150 million funds, and I think they'll do hundreds of investments out of that fund.
Right. Which, by the way, I remember I used to run the Founders Club, which was a venture capital equity exchange fund, and Ron Conway wanted to create a equity exchange fund for SV Angel. And so I sat
Yep.
down with him, this is like early 2000s, and
Yep.
he was the first kind of shotgun early stage, kind of spray and pray investor that I ever met, and probably
Yep.
has done it better than anybody else
He's the best.
before, during, and after. Right,
SV
right.
Angels, the things he built, he's the best.
Right. And now, his son Topher and he are the only LPs in the fund. They're like, that was a distraction. It was a waste of time.
Right.
It's a lot of time to manage other people's money. And so they're just like only doing their perfect trade. But I remember seeing 245 companies were in one portfolio. And I said, well, I want to go through all of them to make sure we get the good ones. They kind of bit into me that if you want to do pre-seed as an institutional investor, VC, even with LP capital, or take it extremely serious. This is there is no outside business activity. This is it. 240 is actually not wrong. The thing about that is that, even if your shotgun hits Google, Facebook, Groupon, everything that IPO'd, which he hit everything to IPO after the dot-com crash, these are small checks weighted down by the other checks. But I do think, like, if you have philanthropic LPs that want to support Rise of the Rest, if they're remotely good, even like a tenth as tall as Topher and Ron Conway, you're not going to lose money. It's illegal to say that when fundraising, but it is. I mean, you're going to lose money on a lot of those deals, but your power laws make up for it. And if you're selling a little bit on the secondary, you can recycle and keep going. But I think that if you're thinking about doing a public service, like you're like Go Berlin or My Patch of the World, having a seed stage fund at scale is unlikely to lose money. It'll make money, but there's some cap, on what you can hit. And when those guys are investing, do you know what are typical valuations? I mean, you're in the middle of the country, your first money in, $150 million fund is actually a sizable fund, for that segment.
Yeah, listen, this is that entity is run by its own team. They sit on the floor here with me. Valuations obviously vary, but you're right. I mean, a big piece of the strategy of leaving the places where there's concentrated capital, we're beneficiaries of this at Revolution Ventures, is tend to be more capital efficient businesses. Very important to us at Revolution Ventures because there's just less capital around to live off of. And valuations typically are more reasonable and modest. But they also come with the downsides of being in less developed ecosystems. Fewer liquidity of talent, less risk-taking culture, et cetera. So it's a balance. And really the role of Rise of the Rest, different than ours, is to have helped fund the development of those ecosystems. Role of Revolution Ventures, very different. So we lead our deals. We do $200 million funds. They're that size for a reason. We can talk about that if you care.
Yeah, no, let's get into Revolution.
Yeah.
So you're in your third decade almost here. You're 20 years in. So that's a guy who's seen the beginning, the middle, and end of how these kung fu movies end here. Right.
Yeah, well, we'll see how the kung fu movie ends. I think the ending keeps getting written. But certainly for us, we do $200 million funds. We'll do 15 deals, very concentrated portfolios.
Oh.
All over the country. So very different than the Revolution, or the Rise of the Rest approach. We take large stakes in companies and concentrate our time and capital against those. And our play really is to be, from the standpoint of our founders, be there for the long term and be reliable. Which, if you have a very concentrated strategy, that really needs to work. And that, I think, is the reputation that we've built. And then, we've kept our funds small so that we can concentrate our time and capital. We've never really grown the amount of capital per partner. We've kept the partnership tight. I've worked with my partners for a long time, and that's really our approach. So basically, a fund structure that allows concentration, and then an investment approach that allows we, as I said, we focus on capital efficient businesses so we can maintain large stakes. By maintaining large stakes and focusing on reasonable valuations, we can be in companies that don't require billion-dollar exits to still drive a venture return. Because when you're investing all over the place, you can't count on consistent billion-dollar exits to drive that. So we have a strategy that we've executed on for a long time that works against that, and we think it's one that makes sense for our approach to investing.
So did you say 200 million was fund size and a
Yeah,
portfolio?
we consistent. Yeah.
Okay, so 200
So
million fund
basically, we
size.
have growth funds that are about $500 million. We have venture funds that are about $200 million. And the rise of the rest funds are about $150 million. But different, similar philosophies, very different investment approaches across them, and we're run independently.
So on Revolution itself, what's the range of stage for the company at the time that you make an entry point investment, and
Yeah,
what
so
is the playbook for reserves follow on if it's going well?
yeah, so Revolution Ventures. We used to say we're a Series A fund. The lines are so blurred; it's hard to know what that
Right.
is. Really depends on the situation. We'll do later seed, earlier A, but our initial checks are typically less than $10 million. I'd say the sweet spot check is probably 4 to 8. But if it's a partner or it's a founder that we've worked with before, where we have a general approach of trying to take company risk instead of market risk. So when valuations get a little out of control, we'll go earlier stage with people we know to try to get away from some of that inflation. So we really sort of vary from seed to Series A, depending on where we think there's a good balance between risk and return in the market.
Okay.
And then with respect to reserves, we hold significant reserves, right? To be able to maintain. The only way this model works is that when a company exits, it matters to our LPs. So for that to happen, we have to have reasonable checks in these businesses, or
Right.
reasonable percentages of the business.
I mean, if you're going down the path of concentrated 15, that kind of volume, ownership matters.
Right.
So if you're doing a $4 million to $10 million initial entry point check, how much can you put into one company? I mean, what's the maximum? Do you have like a
Concentration limit?
a gate? Yeah.
Yeah. So our concentration limit, without talking to our LPAC, our advisory committee, about it, is 10% of the fund. So a $200 million fund, our most recent one, I guess, is 215. So that'd be a little over $20 million per investment. Now, the fact of the matter is we reserve, and oftentimes companies will exit before we allocate that full capital to them. But that's the span. And we'll put $1 million into a company that's in an early stage, that we think makes sense if it's run by somebody we've worked with before. So those are the brackets of how we think about it. But from the mental model for you is founders we like, doing businesses we understand, where we can concentrate our time and capital, work with them through the life of the fund, and in ways where sub-billion-dollar exits can still move the needle for our LPs and for them. Doesn't mean we focus on sub-billion-dollar LP exits, but we really allow. We think it's very important that the CEOs are in a position to make the call. They're not forced because they raised too much money at too high a value. Less money comes in at $200 million. You used this example in one of your podcasts. Money comes in at $200 million value. You raised whatever, 20 or 50 million bucks. Like that VC is going to hold the block on M&A, and they're going to insist on $1 billion exit. And all of a sudden, it creates a weird incentive structure. So we try to avoid that.
Yeah.
We're not perfect, but we try to avoid that.
It's important to know who you're investing with and how that's going to change the dynamic of how the votes are going and who's whispering what in the CEO's ear.
Right.
When I hear a VC saying, to LPs, we expect to get into a couple of decacorns per fund and own 25% at the end, and our entry point is after the B round, I'm like, dude, this is not going to happen. Statistically, mathematically, I don't see this happening. The strategy is remain extremely lucky. It just doesn't sound like realistic. When I hear someone say we're not relying on unicorn billion-dollar exits to, deliver a top decile fund, that makes more sense to me. Do you guys think in terms of this much is, we've got 30% reserves, we've got 70%, 50% reserves. Do you think of that, or is it more of extremely nuanced one-on-one? Of course it is, but what in generally does your
Well, you're
spreadsheet
right. Of
say?
course it is. You learn a lot more as the companies develop and you understand the capital needs of the business. But on day one, we typically think of 100% reserve. So if we put in five in a company, we set aside five more.
Okay.
Excuse me.
Okay.
But
Right. Right.
that's sort of a starting point. And then we obviously modulate it because we're in the capital allocation business.
Gotcha. Gotcha. And what is the interconnectivity between Rise of the Rest and the Growth Fund? Like, you got like Partech in Paris. They've got 200 million seed, 200 million euro Series A, and that's maybe a little blurred line, late seed and A, where they're doing 20% slugs. And then there's 200 million growth, which is they're one of very few in Europe even doing that. Um,
Yeah.
I believe that those GPs all have carry in all three, but they're focused on this is the one you're running. It sounds like these are very separate set of LPs, separate set of economics. But if these guys are right around the corner and you're going out for a falafel for lunch and they're telling you about their seed investment that's turning a corner, there's got to be some interconnectivity there.
Yeah. So we have separate economics, separate teams, separate focus, separate strategies across all of these. And the guy who runs the Rise of the Rest Fund was my very first hire at Revolution years
Oh,
ago.
wow.
And the guy who now runs the Growth Fund is a former SoftBank guy, terrific. And I consider him, one of my, not just a colleague, but a great friend. So, it's not just eating falafel together, but we run separate funds with separate approaches. We have the benefit of shared wisdom, but they're really separate entities.
And over time, I mean, some funds have a policy of never invest cross-funded in the same company. Other ones do have policies that make sense there. Do you find yourself investing out of Revolution into some of the Rise of the Rest? And do you pass your pro ratas onto, Revolution Growth rather than Alpha and other great guys that are looking for your growth pro ratas?
Yeah, so it's interesting. I think the greatest benefit of this is we give our portfolio companies an opportunity to pitch off Broadway. Very, very comfortable, familiar environment to to get the right tone, right approach to fundraising. We can do it internally because we have an earlier and a later stage effort, and then sort of us in the middle. And that's, I think, the biggest benefit. But ultimately, we're fiduciaries on behalf of our portfolio companies. Our CEOs want to raise from the right partner with the right dilution at the right time. And there's a lot of fish in the sea. So I think that's the way that we work together most closely.
Okay. And talk about, I mean, every individual is unique, so every team is unique, but how are you guys different? And let's focus on your team with Revolution. If the founder has got a choice of not just American and United Airlines of who to fly, they got a lot of choice in what VC to work with.
Yeah,
How are you guys different? I mean, I've always
yeah.
thought it'd be interesting to hang out with you guys because it's like the lore of
Come back to
AUL
DC.
and
Come back to
let's go back to
DC. Yeah.
DC. It sounds like an interesting dinner table to be at, but how do you guys add value? How do you differentiate?
Yeah. So, this gets back a little bit to I talked about the deliberate nature of keeping our funds the size they are. And we do that specifically because the way that we feel we add value and make money is being available to our entrepreneurs. It doesn't mean, that we're in their hair at the wrong times. But one of the important parts of our diligence is getting a sense of whether we understand the business, whether we think we can be helpful in that business, and whether we're working with a founder who wants to work with us. And if so, then we're willing to take on that company risk that I was talking about in a concentrated, serious way. And the trade that we make in exchange for that is we're there in the good times and the bad. Some of the best returners that I've had are in companies that have really stumbled in the meantime, have taken a lot of work, oftentimes when other VCs literally like walked away and sort of dust off their hands. It doesn't mean we're perfect. It doesn't mean that, everything ultimately works out. But that's really, I think, what our approach is. So that's why we keep our fund sizes what they are. It's why we do like 3 to 5 deals a year in terms of pacing. Our strategy is that. In terms of areas we focus, And I should say also, we started by being willing to invest in places that others weren't. That's normalized. And we still bring a lot of wisdom of DC, and this matters today more than it ever has, in terms of regulation policy. I mean, literally, the guy who sat in the office between me and Steve for 15 years went on to be the chief of staff to the president. He's now gone on to be the sort of head of policy and head of legal over at Airbnb. But this is kind of the world that we live in. So those are, I think, sort of our unique approaches to the world. And then we're willing to structure deals in such a way that, as I said, can work for outcomes that don't require billion-dollar exits. If you talked about this, our strategy is to have 2 decacorns per portfolio. And if I'm smart enough to do that, I guess I'd execute against that strategy too. But it's somewhat self-fulfilling. If you believe your strategy is only to have $10 billion outcomes, it completely affects how you think about underwriting everything.
Yeah.
Right? You will pay whatever it takes to get into whatever deal. And your strategy then is purely about access and capital deployment. And then moving on to the next one, jettisoning things that don't work as quickly as possible because they're a distraction, not a good use of time. And that's a perfectly good strategy for people who are smart enough to invest in multiple decacorn funds. Ours is, I think, more roll up your sleeves and go to work. And that's a strategy that works for us.
Yeah, I think that the real operator turned VC enjoys spending 80% of the time with the bottom 10% of their portfolio going through choppy waters, and that's like stop and smell the roses. This is like the job. And it's
Right.
like combat, and sometimes you make it through alive and sometimes you don't, but you put your best in. If you're 15 companies a portfolio, that's interesting. So how many partners are there that are like board seat, IC level partners? And I think you said 3 or 4 a year. So what is the investment pace to deploy an entire fund? And what's the investment pace to establish a position in 15? And maybe how often do you raise the next fund?
Yeah.
And all those
So,
tie together, to, bring into focus what's happening here.
yeah, no, that you're such a student of the game in this. Those are such fundamental questions that really drive what your strategy, how big the fund is, et cetera. So for us, we have very standard terms in our funds, except for one. We actually have a longer investment period than is typical, because we
Probably smart.
have
Probably smart. That's
a
recognizing that it's not the same world we were in of like, 12-year funds. You're going to get bent over when you sell to a secondary, if that's really true, if you're in venture.
right, and we have a 6-year deployment period. Now we don't necessarily use it, but we tend to, right?
But that's old
We
school. That's old school LPA. 6-year commitment period. Get rid of it in 2 years. Right? That's
Right.
kind of typical.
Listen, it would have been easy, probably, you know, wouldn't I think we could have raised the capital, and I think it would have been easy to deploy the capital, and certainly from a fees standpoint, we would have made plenty more by raising bigger funds, deploying them faster. Listen, it's a siren song. It's easy to understand why that's attractive to the GPs. But at the end of the day, a lot of the capital from an LP standpoint is ours. We talked about alignment. That's how we started this, right?
Yeah, I can believe that.
We
Yeah.
we pay fee and carry like everybody else, which our tax people think is crazy, our lawyers think is crazy. But we like just being able to tell our LPs we're in the same boat as you are. So we will deploy capital, back to your question, at whatever rate we think makes sense in the market. So when things got super frothy, and like in
2020, 2021.
well, and so in 22, we basically viewed that as, or in 22, we viewed that as like 21 pricing and 21 risk. So we really stood down in 22, and we just, like, the market was shaking out, and we stood back and didn't make a single investment that year. In 23, when people were starting to
Need the
invest
money.
less because
Yeah.
we deployed, I think we did 6 deals last year or something like that.
Okay.
So that's our approach to the world. Very, when I talk about taking company risk and not market risk, that's what I'm talking about. We will pass on companies that we think are interesting because we don't think the deal makes sense. But
Sure.
we will do lots of deals when the company makes sense and the market supports it. That's our
So
approach.
when now it's hard to say, in a time when there's no volcano going off, there's no war happening, there's no pandemic, there's no 2021
Right.
spike in
Yeah.
ridiculous prices. But if things are going somewhat normal, how many
Yeah.
new companies would you invest in per year to get to your we've established a position in 15 and then raise a new fund? So that's two questions. How
3 to 5.
frequently should you
Three
raise
to
a fund? So 3 to 5 years.
3 to 5 years.
Okay. Okay.
So we do 3 to 5 deals a year.
And how many partners are there that are,
Three of
leading
us,
investments?
3 investment partners, and we've worked together a long time.
Right.
We're big believers in. So our third partner, Clara, started her career here and sort of graduated up. We're proud of the culture that we've built. Where it's a partnership where people actually enjoy working together, and that's super important to how we think about building a firm.
Yeah. And by the way, a lot of people confuse what you're doing with, or like the media talks about how many venture capital deals were closed last year and what was the volume of investing. And I'm like, are you including Carl Icahn and what Revolution and 7BC is doing? Because that's not even venture to me. Someone writing a $5 billion check into something. But for real
Right.
venture like you're doing, this is what I think of as a real venture capital. Talk about governance. So if you're putting in 10 million bucks into the company,
Yep.
often, I think, what was a promissory note, convertible note, safe notes, I think have been overused. And I would have liked to have
Yep.
seen more price rounds and get the clock ticking on QSBS. But if you guys are doing 4 to 10 million, this is entry point. What does the
Hmm.
board look like if they even have one before you showed up? And what is
Yep.
the governance going to say? What's the best practice that you're finding now?
Yeah. Well, listen, I can't speak to best practices for others, but we definitely have a view on this. We're taking large positions in companies, and we expect them. We view ourselves as assistants in transitioning from looser conceptual companies to something that's institution grade. So, we typically don't go outside the NVCA standards, et cetera, but we don't do safe notes. We don't do convertibles. We price our rounds. We put equity into companies.
Good.
We agree on what that looks like. And then we establish a board structure. And typically, at the point at which we invest, um, it'll be, will be one of three or two of five with one that deletes. So by two of five with one that deletes, that would be either 3 common or 2 common and an independent. And independents are underappreciated, I think, in
I
venture.
like the independent.
Uh,
I like two. I like two for the founders, including the CEO, two for the money leading an A, and one mutually agreed
yeah,
to. I think that's the right
and then
thing.
so
Personally, maybe I'm just old.
and then what? And then well, I mean, you and I have been in this business a long time. We'll often agree that that second one, because this is a mentorship business. I just talked about the importance of culture and bringing people along. We'll fill that with somebody who's maybe more junior on the team, but agree that when an institutional round comes in for the subsequent either A or B, that rather than change the size of the board, we will hand that off to the new investor. So basically, do the work now to make it look institution grade, and then sort of keep a logical structure as we go forward.
Okay, so let's switch gears before we run out of time and talk about the
Yeah,
sectors. Like, what's happening in the technology world? What is exciting you guys the most right now? What do you
yeah.
want to be backing
So
technology market ways?
yeah, so we called the firm Revolution in the early days because we had this concept that's obviously very mainstream now of essentially revolutionizing what now most people call disrupting existing billion-dollar categories. So we like to go to places where there's white space. Doesn't mean that it has to be an enormous TAM, just a place where a new business model, usually informed by technology, can, if it's a big TAM, can just have nice tailwinds, or if it's a smaller TAM, can take a large slice of that market. So that's sort of one thought process. So in the latter category, we're invested in a company that's down in North Carolina that is doing software for accounting firms. And it doesn't sound like a huge category, but they're killing it. They're doing really well. Bessemer followed us on the round, and like they're going to play a significant role in that category and they're going to do fine. The other end of the spectrum, an early deal that we did in the early days of Revolution was betting on a major transformation, a huge category. And I think we were 2 steps ahead on that category. We did fine, but the company that ultimately became Zipcar, we took that public. Benchmark was in that deal, and then ultimately Avis bought it. That was the first real sharing economy deal, and that was a huge sort of concept. Now the big money ultimately was made when people found a more capital efficient way to do sharing economy deals. Capital
But it was
efficient if
still
you take away the
challenging the
cost of
notion
acquisition.
of car ownership, and then it turned into a car sales business, I heard. So I think that is quite clairvoyant, to
Yeah,
be into
yeah.
Zipcar.
So that's how we think about it. Disruption is a category we like. We do a lot around financial services, fintech. We've done insurance related things. We've done infrastructure related things, and we'll do lending related things. My partner David does most of those, and we have a lot of consumer sensibility through the firm. Consumers got its own set of challenges: customer acquisition cost, LTVs, repurchase, et cetera. But so we like to look at consumer when it's got a business element to it. We recently did a healthcare deal that consumers love, but ultimately it's billing through the payers with hospitals. So it's consumers like it, but it's got a traditional payment structure. Or a deal like Framebridge. Framebridge is a deal that we knew the founder, sat down with her before she started it, encouraged her to do it, did the seed, invested through time. And basically her thesis was frames, like literally picture frames that you go to the store. It's crazy that they cost $500 or $1,000 to frame a $30 poster.
Yeah,
Bonkers.
yeah, yeah. No,
There's
no,
actually
it's terrible.
there's a fundamental reason that it's like that. Like they build frames. The today the way they built frames 50 years ago, and her
900
idea
years
was
ago.
if we build a factory, like we should be able to do it more economically. So those kinds of consumer deals will do because they fundamentally change the economics and support the cost of customer acquisition, et cetera. So those are areas that we think about: disruption, fintech, smart consumer.
And so 20 years into this, and even longer considering what you were doing before and with the corporate background, let's talk about exits and close up on exits.
Yeah.
Uh, what is the time delay between typical Series A and exit in general? Of course, there's enormous variance in there, but what's an adult answer on that question?
Well, I think before the adult answer, the enormous variances, obviously. Yeah, it depends. Our quickest exit that was a positive exit was, less than a year. A company that was sort of the right idea at the right time, got momentum. The economics of the business were changing. And I remember this is a company called Order Up. It was a thesis-based investment for us. It was food delivery in secondary and tertiary markets, back when only Seamless and Grubhub were the competitors in the space. Uber Eats didn't exist. The big players weren't there. We were the first investor in a company called Living Social. That's an interesting exit story we could talk about. And they had done a little experimentation around food delivery, and we're like, there's a there there. So we invested in that business, great entrepreneur. But in that period of time, that 1 year, all of a sudden, new entrants came in. The economics started getting hollowed out. And I talked to the CEO, and he said, Tige, I think it's like a time to exit, but I don't want to feel like a wimp. So we tell the story, I'm sure you've heard this, of the rich uncle. You go to your uncle, hey, uncle, how'd you get so rich? He said, I sold too soon. And he still tells that story, right? So that's one end of the extreme. The other is, we still have deals that I work actively on that I think are compelling, interesting deals that are out of the investment period, et cetera. We're not going to sell into the secondary because I'm a big believer and I spend as much time on those things as I do on a new investment. So with that caveat, typical is, I think, 6 years from the time when we invest to when we ultimately exit.
Okay. And by the way, I open every chapter with a quote to kind of smack the reader into being awake again in my books. And in my chapter
Uh,
on M&A from book number 1, I have this quote, which I love. It says, I made most of my money selling too early, JP Morgan.
right.
And I swear to you, the longer I do this job, the more I'm like, there's even more wisdom in that to me now than there was before. of like if the
So,
company's
and by the
raising at
way,
2.5 billion, should we be selling 50% when I've been in the deal for 8 years? My LPs need money.
so your LPs will appreciate it. I think we oftentimes will exit some, but not all.
Right.
A good example of what you talked about was Living Social. We were the first investor in Living Social. It was this crazy time. Groupon emerged. Living Social became its competitor. There were 1,000 companies there.
Daily deals was
And
the flavor of the month.
daily deals was a thing. We had just raised capital from two great VCs. Um, and Amazon came knocking to make a strategic investment. And I'm a big believer in strategic partnerships accelerating. And at that point, it was Groupon and 999 other companies. And we thought we were smarter, but like everybody thinks they're smarter. So I argued hard to take this investment. The new investors didn't want to take the dilution. So we arranged a deal where we sold into that to make room for Amazon. Everybody took a little dilution. We sold some shares in to make room for it, but in exchange had the right to sell into some additional financings. We sold over time half of our stake. We never sold more than half our stake. And then ultimately it was one of these things. At the very end of it, we put the last money into the company just to help get it landed. I stayed on that board longer than any employee stayed at the company. But we also made more money on that thing, I think, than we ended up doing well because we took some off the tail. We sold too soon, but we didn't sell everything. We like that strategy.
Well, that's how JP Morgan made most of his money, right? I made most of my money selling too soon. Selling too soon.
I'm no
so
JP Morgan. I'm no JP Morgan.
Okay, final words on the exit market right now today. What needs to change? Should we bring back the days of the IPO for earlier companies? Should the government be preventing M&A? What's your view on the exit market right now?
Yeah, so I don't ever think companies that are too early should IPO. That's just a bad idea. It's a recipe for getting stuck inside your cap table, no access to capital, disappointing short-term investors. Like that day should never be here. I do think that my personal view is the antitrust environment's tough right now. These big buyers who are scared to death to try anything because they keep getting their hands slapped, they are the logical exit. And at the end of the day, for a large percentage of companies, and at the end of the day, if you want innovation to happen, it happens in young companies. And if people can't make money growing those companies and exiting them, 90% plus of exits happen not through IPOs. Of that 90%, 90% plus happens before the Series B. So whatever that math is, 80% of investments exit in like the seed A or pre-V stage. And if you take that away, it's bad for the ecosystem. So I think it's a tough environment right now for exits. Maybe it was too loose at one point. Maybe it's too tight right now. Somewhere in between is better. But it is, you need an environment that supports it from a regulatory standpoint. You need acquirers who are rewarded for taking risk. And then you need good companies. And when those things align, we're going to have a robust M&A market again.
Well, it's great to talk to you here and see the concentrated focus on 15 companies, taking a multi-year view of things, getting really deep involved with those companies. I think it's a great, great classic model, and I'm happy to see you guys are doing it. I got to get myself over to Washington, D.C. I love the place, and we'll sit down and get you guys to invest in our companies that's fitting your model. Can't wait to do it.
Get out to D.C. We've got an office waiting for you. We'll look forward to it.
Okay, Wilson, thank you so much for coming on, and talk to you soon.
All right, thanks, Andrew.
Bye for now.